Hello, Ed Alisauskas here with Senior Legacy Solutions. I was driving in between appointments with clients and I thought I'd pull over. I was listening to some of the financial news and it made me think about the last couple weeks. And today is September the 10th, 2015, to give you a reference point. Anyways, as I'm driving and thinking, I'm thinking the last couple weeks have not been very kind to the investor. We had quite a drop in the stock market. In fact, I think one of the days was the single biggest drop in the stock market in its history, at least for decades. Now, you're making some comeback, but in all honesty, the market this year has been flat or down at best, or flat at best. So you're not really doing well for all the risk that you're taking. And I also thought a little bit further as to what might be causing this. I'm thinking the 1980s, we had a real economy. We had a booming economy. And forget political parties. You have a good economy or you don't have a good economy. But we had a real one. We didn't have the deficit we did. We had people still working full-time jobs. In a lot of cases, families had only one breadwinner, which is very unusual nowadays. You almost need two just to survive. So it's a different world, different economy nowadays. In the 90s, you had the technology spurt, the dot-com boom, if you will. That's when the whole internet was starting up and a lot of advances in technology. So you had rallies on Wall Street because of that. Now, I look at today, and our economy isn't great. It's not booming. We're 19 trillion in the hole. We still have a tremendous trade deficit on the average. Our unemployment rate, although it recently went into the low fives, let's peel away that rate for a moment and see what's really behind it. 94 million people have dropped out of the workforce, either too old or mostly because they just gave up work and gave up finding a job. And it's not easy anymore. What you have nowadays, and I used to, in my former life, I used to call on purchasing managers, and any company, even mid-sized, small ones, had 3 or 4 purchasing managers. Try doing that nowadays. You have one person who's also doing something else and doing the purchasing. So the jobs are not what they used to be. Companies are a little bit more lean and mean. And okay, the stock market was rallying for years and years since we had the great fall in 2008. Well, what's the government doing? Are they propping up the economy? Are we booming? Do we have these wonderful full-time jobs with great pay and benefits? Not really, not what it used to be. They're printing money, number one, what they call quantitative easing, basically legal counterfeiting, as I call it, to prop it up. They're also keeping interest rates low. Now, if we have a booming economy, why would you need to do that? In fact, anytime the Federal Reserve chairman says, you know what, we might see the end of the year, we're going to boost the interest rate up. What does Wall Street do? Down. Okay. So they're keeping they're keeping the interest rates incredibly low because people are looking at a checking or savings account, which days gone by used to make 4 or 5%. Just your savings account, 4 or 5%. Your CDs made 6, 7, 8, 9%. Okay, now it's 0.05, and your CDs, if you're lucky and have to keep them there for years, is 0.3, 0.4%. So they go, okay, you know what? That guy seemed friendly that gave me a card from that broker down the street. He seems like a nice guy. You go to him, you sit down, and this is no offense to my stockbroker friends, because there's a need for that, and I'll explain that in a moment. But they sit down and they go, okay, here's our retirement money. We saved all our life doing this. And he says, well, Mr. and Mrs. Jones, we're going to diversify you. Oh, great. What does that mean? They put them into big company stocks, into small company stocks, foreign stocks, technology stocks. What's the common theme here? They're all stocks. They're all risky, okay? Some sectors riskier than others, but it's all risk. Now, to their credit, to the stockbroker's credit, if you're in your 30s and 40s, you're working, yeah, okay, because no matter what happens, you're putting money back into it, okay? But when you're 60, 65, ready to retire, don't. I'm strongly suggesting you. This is not advice of any kind. I'm not a financial analyst, not one of the pundits on TV, but I've seen tremendous losses with some of the seniors and the retirees that I work with. So what do you do? How do you play it safe? The banks pay no interest. The stock market is too risky. Well, I may have something for you, and if you give me a call at 866-723-6669. That's 866-723-6669. I can give you the ability to play the market safely, so when it goes up, you have a little bit of a gain. You see it. If it goes down, you don't lose any money, no losses. You can sleep better at night knowing whatever happens. You can have a nice steady set fixed interest rate. You can also supplement an income that you may have lost for the rest of your life. How does that sound for you? The nice thing is any gains are all tax deferred, so Uncle Sam doesn't have to touch it. Again, Ed Alisauskas with Senior Legacy Solutions. I thought I'd share a little bit of information with you. Please give me a call, 866-723-6669. As always, thank you and God bless.